Rémy Cointreau Q1 sales publication conference call. My name is Alan, and I'll be your coordinator for today's event. Please note this call is being recorded, and for the duration, your lines will be on listen only. However, you will have the opportunity to ask questions at the end. This can be done by pressing star one on your telephone keypad. And please limit yourself to two questions during your turn. If you require assistance at any time, please press star zero and you'll be connected to an operator. I'll now hand you over to your host, Luca Marotta, CFO, to begin today's conference. Thank you.
Hello, everyone. As you have seen in the press release, Q1 sales were down minus 15.6% in organic terms. This performance of the quarter reflects a continued destocking, particularly in the US, high base of comparison, notably in APAC and EMEA, as well as a soft context of consumption globally, alongside a strong promotional activity. Overall, the Q1 sales decline is split between a strong volume decrease, minus 20.2%, and plus 4.6% price mix effect linked to limited price increase and a lower decrease of cognac compared to liqueurs and spirits that gives the mix effect. Looking at the overall sales performance by region, America generated a strong sales decline, reflecting the stocking in the market, not showing any sign of depletion recovery yet. APAC recorded a slight decrease, mostly affected by Southeast Asia, while China was almost flat due to high comps and in persistent tough market. Finally, EMEA showed a very strong double-digit decline, impacted by high comps, some phasing effect, and also some softer consumer trends. This was sell-in, shipment. In terms of value depletions at group level, all brands, over the past 3 months, starting with the US, value depletion were down strong double-digit. Compared to pre-COVID, value depletion were up plus 10%, and clearly stripping out the SOP, excluding the SOP, plus 55%. In China, value depletion were down mid-teens in the Q1 versus last year, and as well compared to 1920. The latter one can be considered particularly negative. However, and we'll be back on that point, I'm sure, I would recommend not to pay too much attention, considering the very short period of time, which creates some volatility, small size of Q1 for China in absolute value, and a different split in terms of business compared to 1920 linked to duty free. On top, and we'll be back on that, you have to combine that at least 6 months moving average, reminding that the last quarter we are 200%, 3 times the weight of 1920 value depletion, the footprint in China. So you have to combine that. Following the strong rise in Q4, this is the situation in China. So value depletion should be appreciated on a rolling basis. So combining that in terms of numbers, they are up plus 70% versus 1920 on 6 months, and up mid-single digit versus last year. Once again, Q1 cannot be appreciated alone because it's a small, volatile quarter. Finally, a word on EMEA. Value depletion were down mid-teens versus last year, and down low single digit compared to Q1 1920. But excluding Russia, value depletion would have been flat versus 5 years ago. Overall, at group level, that means that 3 months value depletion decline of 4.5% on a 5-year basis, in line with selling trends, minus 4. But this global alignment, compared to 5 years ago, includes some contrasted situation. 1, strong destocking in the US, clearly, is there. Second, a more natural evolution in China, where the small size of the quarter cannot really influence the level of inventories. And third, a more or less neutral evolution compared to 5 years ago in big EMEA region. To conclude on this very first slide, we confirm our full year guidance. On page number 3 and 4, we pick up some main marketing initiatives, as usual, of the quarter. And as announced in June, and as part of the US plan to improve growth rates, we have started improved their investment rate behind VSOP to improve its visibility on the point of sales, the conversion rate. We continue to leverage cocktail momentum through activation around Cointreau, particularly during the week of Cinco de Mayo. Results are positive, depletion speaking, all channel and coverage included. In parallel, we have deployed the Monguet last innovation, Eclipse Nadi Strength, which will contribute to improve the profitability and the visibility of the brands. And finally, last but not least, we pursue our efforts around the Bruichladdich, the single malt Scottish whiskey, to increase education and awareness. This is only the beginning, and we hope that we'll be able to improve next trends in the US. On page 4, a quick word on China e-commerce, and particularly the good result achieved on 18 of June, Shopping Festival, that realized, conquered a plus 14 sales growth. As mentioned by Eric Vallat, e-commerce is a very solid weapon for China. The ambition is to continue to grow, building on a team whose know-how and relationships and soft skills with the key players are a true asset and a competitive edge. We have successfully launched 2 exclusive new products for e-commerce channel and achieved a great depletion number through 618 campaign. And in parallel, at the same time, we leveraged the pop-up stores that we opened in Shanghai to celebrate the 300 years of Rémy Martin using live streaming session and social media. Now, let's go back to dry figures, moving to the Q1 sales analysis, slide 5. Sales amounted to 217 million euro, down 40.5 million euro year-on-year, or 15.7% on a reported basis, 15.7%. This reflects, first, a very strong organic decline of 40.2 million euro. It means 15.6% of organic sales decrease. This performance is split between, as said, minus 20.2 in negative volume effect and plus 4.6 of price mix. And as said, by I repeat, it's important, this is a combination of the slight positive price effect and low to mid single-digit positive mix effect. We have also to highlight a very slight negative currency translation impact of 0.4 million euro or 0.1 loss for the quarter, so very marginal. But this is interesting because this loss is really mainly driven by the duration of the RMB, the Chinese yuan currency, for 1.2 million, and of the Japanese yen for 0.4, and in parallel, in terms of conversion, US dollar turned positive with a gain of 0.9 million euro. On slide 6, the usual performance by division versus now 5 years ago, pre-pandemic, Q1 1920. I will not detail all the figures because they are clearly highlighted on the slide. But in a nutshell, volume performance is strongly down in cognac amidst the current US context, while price mix continue to be very strong. Overall, total cognac sales are now down 17% versus pre-COVID, while value depletion are strongly down at the same time around minus 20. In parallel, Liqueurs and Spirits division continue to generate a significant performance of plus 35.1% versus pre-COVID, driven both in combined and balanced way, volume and price mix, and well below value depletion trends, which set at plus 45%. At group level, this shows a global symmetry between sell-in, minus 4, and value depletion, minus 4.5, versus Q1 1920. But inside that, they have different situations by region and by division, as highlighted, as suppose. Let's now turn to slide 7 to dig in more analytical organic trends by region. And let's start with APAC, whose Q1 organic sales were slightly down year-on-year and up at the same time more than 20% on a 5-year basis. If we look at the volume value equation, the performance year-on-year include a strong positive price mix effect and a low double-digit negative volume effect. Inside that, China sales were almost flat in the Q1 in a market that remains complex, tough, particularly for the high-end segment. In this gloomy environment and market, the only channel we can say we emerged very clearly and positively is the e-commerce. In the quarter, it grew more than 15%, representing more than 35% of sales penetration in China. The overall performance also reflect strong negative impact coming from Taiwan, Macau, and Hong Kong. In this context, Q1 value depletion, so not sell-in, but value depletion, best approximation sell-out of the group, at group level, in the region, were down mid-teens year-on-year, and as well versus Q1 19/20. But I repeat, plus 70% on a 6-month rolling period versus 19/20, to take into account some phasing effect between Q4 and Q1 of this year. Moreover, the misalignment between sell-in and depletion does not impact our level of inventories, which remains healthy at the end of June. Remaining part of Asia reported mid-teen sales decline in Q1. Market is very tough in Southeast Asia, particularly in Australia, Malaysia, and Singapore. At the same time, Japan, on the positive note to this publication, generated very strong sales growth boosted by tourism and partially also the weak yen. At the end of June 2024, APAC region accounted for 39% of our group sales, up 4 points compared to last year. Let's talk about Americas. Q1 organic sales were strongly down again year-on-year, and down -25% compared to 5 years ago, mostly impacted by volume, while price mix was slightly negative. And talking about the US, well, sales recorded a strong sales decline in Q1, impacted by continued destocking, given the absence of signs of depletion recovery yet. Despite another round of destocking in absolute value in the US, which now brings down the level of inventories to the level of pre-COVID, this is not visible in terms of days of stock coverage, considering a further sequential deterioration of the depletion over the quarter that just ended. But the absolute value are very, very, very low. As a consequence, in terms of amount of coverage, level inventories in the US is still around more or less of 5 months at the end of the Q1. On a 3-month basis, value depletion are down strong double-digit year-on-year, and more or less plus 10% compared to Q1 19/20, and as I said, plus 55% excluding VSOP. In Canada, sales were down low double-digit in Q1, impacted by cognac, and Latin America were also down at very strong double-digit. End of June 2024, Americas now accounted for 35% of group sales, which is the same weight of the last year at the same period. Finally, the third region in terms of size is EMEA, big region, in which Q1 organic sales were down a very strong double-digit and grew at low single-digit versus 5 years ago. This year-on-year performance mostly includes a very strong negative volume effect. Digging in, Western Europe was down a very strong double-digit in Q1, affected by Germany, Greece, and Spain, facing high comps and some destocking in a couple of countries. However, this quarter showed a strong disconnection between sell-in and depletion. UK was down double-digit in Q1, impacted by high comps, as Q1 of last year, 2023-24, were boosted by some restocking ahead, you remember, of the rise in excise duty in the country. In addition, the economic context shows some encouraging sign of improvement of the back of less inflation, positive effects that start to be seen on the final consumption, on sell-out. The remaining part of the huge EMEA region, sales were down a very strong double-digit, impacted by the stocking in Africa, Middle East, some negative phases linked to the Orthodox New Year in Eastern Europe, and negative cognac trends in Benelux. Over the last 3 months, value depletion, so more linked to the sellout, were down mid-teens year-on-year and down low single digit on a 5-year basis. Excluding Russia, however, value depletion would have been flat compared 5 years ago. Overall, inventories are now back to healthy level, slightly up compared to the previous quarter, but we said at that time they were a little bit on the low side. End of June, in terms of weight, EMEA region accounted for 26% of group sales, down 4 points versus last year's. So, in terms of weight compared to 1 year ago, America's flat, EMEA -4, APAC +4. Now, let's turn to slide 8 and the analysis by division, and we start by the Queen, so Cognac. Cognac posted a Q1 organic decline of 12.2%, reflecting a decrease of -8 in volumes and a negative price mix of -4.2. End of June 2024, Cognac division accounted for 62% of our sales, up 2 points versus the previous year. In this Cognac division, let's start with the APAC. And inside APAC, let's start with China. China sales for Cognac were flat in Q1, affected by high comps and a weaker consumption. In a nutshell, consumer confidence remains low and continues to impact consumption, while cash pressure as well weighs on wholesalers. As a consequence, value depletion were down mid-teens in Q1 year-on-year and versus 5 years, but within this global evolution, Club, our key reference, is clearly overperforming, while the high-end products are a little bit more on the underperforming side. By channel, on-trade is the most affected one in the current context, also in terms of downgrading and lower spend per capita, while e-commerce is clearly up, I repeat, plus 15%, boosted by the 618 festival and banquets, which were relatively resilient during this low season. On the negative side, Hong Kong, Taiwan, and Macau were particularly weak, impacted by high comps, destocking, and tourist preference for Japan over Hong Kong. Rest of Asia was down mid-teens in Q1, particularly impacted by Malaysia, Philippines, Singapore, but on the positive side, Japan generated a very strong double-digit growth in the Cognac division. Second region in terms of weight, it is for the Cognac is Americas. In North America, Cognac sales were down low double digits, still impacted by the stocking on the back of persistent negative depletion, which are not showing any sign of spark yet. Overall, the market remains highly promotional, and underlying demand continues to be weak. Q1 U.S. value depletion were down a very strong double digit for Cognac year-on-year and -10 versus Q1 of 5 years ago, showing a sharp underperformance of the SOP. In fact, Q1 trends are below Q4 of last year. However, we should consider the high comps that explain this sequential deterioration. Indeed, June depletions were up mid-teens last year in 23-24 before the implementation of the price increase from wholesaler to retailers beginning end of June, beginning of July. Considering all that, and what already said, the level of inventories in Cognac in the US is still around more or less 5 months in terms of day book coverage. That is one of the lowest level in terms of absolute value. 12 months value depletion, rolling 12, includes 2 points of negative price mix effects year-on-year, end of June. On a 5-year basis, price mix is up 18 points. Finally, a word on Latin America sales that were down for Cognac, very strong double-digit in Q1, impacted by a very strong, fierce promotional competition. In EMEA, Cognac sales were down a very strong double-digit, reflecting high comps, negative phasing, and softer markets. Overall, EMEA was mostly impacted by South Africa and Germany. The UK showed a relatively good resilience despite very high comps. As a reminder, last year we benefited from a strong restocking effect ahead of the rise of excise duty, And in addition, I repeat that because it's important, sell-out shows early sign of improvement alongside the inflation decrease, which is encouraging. Western Europe, as a sub-region, was down double-digit in sales. However, sell-in was well below depletion and sell-out, which is something with a positive expectation for the next months. Finally, overall, EMEA value depletion were down mid-teens year-on-year in Q1, and down very strong double-digit compared to Q1 1920. Let's now turn to Liqueurs and Spirit division on slide number 9. Liqueurs and Spirit division was down -20.4 in the quarter on an organic basis, including a very strong decline of volumes, almost 24%, 23.9, and a positive price mix effect of 3.55%. End of June, Liqueurs and Spirits division accounted for 35%, 35, down 2 points versus last year. Let's now review the performance of the division by region. In this case, most important region is Americas. In North America, sales were down double digits in Q1, of which Canada was up low single digit. North America was impacted by some destocking alongside the greater cautious from wholesaler in a slowing market. So the cautiousness of the wholesaler is impacting as well Liqueurs and Spirits, creating some mathematically speaking inexplicable disconnection between dynamics of depletion and replenishment in selling. However, the underlying trends are resilient, as shown by the Cointreau Q1 US value depletion, all channel, which were up low single digit year-on-year, and approximately plus 95% versus 5 years ago. So Cointreau doubled its size of business compared to 5 years ago in terms of value depletions, all channels. Botanist, our gin, also showed positive trends. Beside all that, price mix was down 5 points versus last year in the last 12 months period ending June, and up 18 points on a 5-year basis. In parallel, Latin America sales were down, also for this division, very strong double-digit in Q1, once again for a persistent promotional market. EMEA, a very strong region, important region for Liqueurs and Spirits, realized sales for Liqueurs and Spirits that were down strong double-digit in Q1, impacted by high comps, negative phasing effect, and a softer consumer trends. In parallel, value depletion were down high single digit versus last year in Q1, but 30% more than 5 years ago. Inside all that, while Benelux shows a good resilience driven by Cointreau, UK was impacted by high base of comps, and in Western Europe was sharply down on the back of high comps, some destock in Germany, and overall a soft market. For Eastern Europe was impacted by some destocking, following also some slight changes in route to market. Third region so far in terms of weight for Liqueurs and Spirits is APAC. Inside APAC, China. Let's talk about China. China posted for this division a strong double-digit decline in Q1, impacted by continued destocking in whiskeys and a weakened demand, mainly from younger generation, more volatile in terms of habits. However, value depletion were strongly positive for Cointreau and the Botanist, while Bruichladdich value depletion posting a more limited decline, so some small sign of positive inflection compared to previous quarters. Overall, value depletion were up high single digit versus last year and increased 40% versus 5 years ago. So, focusing on 5 years ago, at the end of Q1, Cointreau plus 95%, and APAC, EMEA plus 30, plus 40. So a huge increase of the footprint of Liqueurs and Spirits and Cointreau, more especially in the region, so in all the regions for the group compared to 5 years ago. Rest of Asia posted a mid-teens decline in Q1. Southeast Asia faced a sluggish consumption, Australia, New Zealand mainly, but we continue to gain market share in a very depressed market. Japan still booming, also for Liqueurs and Spirits, driven by Bruichladdich and Telmont Champagne. One last word on the performance of non-group brands, which represent almost 3% of group sales, so stable compared to last year and the year before. They were down minus 24.6% in Q1, and -14% versus Q1 19/20. This is clearly okay and fine with the strategic journey that Eric Vallat put in place 5 years ago. To conclude, let's switch to page number 10. On the back of Q1 sales results, which do not show any specific news, nothing new under the sun, we confirm our full-year guidance, which includes 2 distinct periods. H1 sales is still impacted by US destocking, high comps in China, and softer consumer trends in EMEA. H2 sales that are expected to show a recovery, mostly driven by the US. In this very tough context, the group is well determined to use tight cost control and its value-driven strategy to protect its profitability, i.e., its organic COP margin. In the full year 24-25, the group will build on these compounders. First of all, the resilience of its gross margin, thanks to a measured selective rise in price amid moderate inflation. Second, normalization of the A&P sales ratio at a level much higher than in 19/20, but lower than last year. And third, a tight control overheads to offset most of the rise in cost in overheads, resulting for the reversal of a temporary saving achieved in 23-24, as you remember. For the sake of clarity for everybody, this guidance does not take into account any potential impact linked to duties increase in China or elsewhere in the world. No duty increase price taken account in this guidance. Thank you for attention, and now I am happy to answer to your question, but before I have to drink a bit of water. Thank you.
If you'd like to ask a question or make a contribution on today's call, please press *1 on your telephone keypad. To withdraw your question, please press *2. You'll be advised when to ask your question. As a reminder, please limit yourself to 2 questions during your turn. We will take our first question from Andrea Pistacchi, Bank of America. Your line is open. Please go ahead.
Yeah. Good morning, Luca. My first question is on liquors and spirits, which has shown quite a deterioration in the last 2 quarters. So the question is, how much do you reckon of the 20 to 25% decline that we've seen in the last 6 months is really phasing effects, and what is more underlying? And how do you see the rest of the year panning out in liquors and spirits? And from an underlying point of view, where is the most difficult area for your liquors and spirits business at the moment? Is it the US, is it APAC or EMEA? The second question, Luca, please, is a couple of things on tariffs in China. I don't know how much you'll be able to say on this. There's a lot of uncertainty. We don't know, of course, how much the tariff will be. We don't know if it will be still applied to the transfer price or further down the value chain. But two points I want to ask. One, is it reasonable to assume that you will pass it on in full to the consumer? Second, how are you thinking about shipment phasing around the potential tariff? Would you be shipping product to China early to get in before the higher tariff is applied? Would you be able to ship more product to distributors ahead of the tariff, or would this even be possible in the current environment? And any sense of the timing? I mean, we should hear something before the end of August. Do you have any more insight into potential timing of any announcement and potential implementation? Thank you.
Thank you for your question. So we start with tariffs. So what are the latest developments following the hearing on public hearing July 18? A hearing was organized by the MOFCOM held in Beijing, part of the anti-dumping investigation. Everybody was there. The hearing is part of the willingness of the association as well as European companies to fully cooperate, I reiterate that, with Chinese authorities. In this context, the hearing enabled the various European parties to reject the unfounded allegation of dumping, which are neither technical nor legally support, and on our side, we firmly reiterate the absence of dumping, injury, or threat of injury. So what are the next steps? So far, the MOCOM did not make any official communication regarding the exact timing to make their decision. So the procedure is still going on, and we cooperate. Why I'm saying all that? Because, consider the second part of your question, we will not, in a shaky reactivity mood, change our way of making business in China. So we don't take any different habits compared to the previous quarter. So far, the investigation didn't affect the consumer taste or the essence of the business. So we are not changing also the operation to try to anticipate, offset in extraordinary way the technical impact. Because, frankly speaking, we still think that we are on the right side, so we don't see why we should be penalized, but that is not only in our end. And if the day come, we'll be prepared to react. I cannot today that will be everything covered by price increase when, how. In a very calm way, we are there, we cooperate, and we react. We are in a reactive move, and we are not changing nor gears in terms of habits compared to the usual ways of doing business in China. In terms of liqueurs and spirits, dynamics for the quarter and more rolling 6 nights and what will happen in the future. So I will start with the end. For the year 2021-25, we consider that liqueurs and spirits, the stage, will be beat cognac performance. So no change in guidance in terms of division footprint for the 24-25. And also for the medium to long term, liqueurs and spirits is meant, and we invest a lot, and not only in A&P, but on all means to improve the size of the business. So, coming to your question, we think this is more a short-term concern. Short-term that need to be differentiated by region. Let's start with the more easy one in terms of explanation, which is China. China, and it is still a small part of the business, reacting still good. Cointreau botanist in terms of size, the attention is taken by the cognac, but we have to continue to improve its size. And for the liqueurs and spirits negative part, it is more Bruichladdich, the single malt that have a more roller coaster performance in the last 2 years with the high spikes, younger generation getting on it. Part of also of speculation in terms of buying to store and capitalize on the value of the bottles is not something linked only to Bruichladdich, also to some other brands of our major competitor in this business, Scottish business. I will not name it, but everybody understand who we're talking about. So this decline is linked to the volatility of younger generation and some resale value that has been lost during the global gloomy period that we are living in terms of visibility. But it is temporary and is not weighing so much for the overall performance of the group. Second one is EMEA. EMEA is much more a jeopardizing situation because we increased the prices very much, for all, starting with Cointreau. We are clearly on the right strategy, but now there is a pause in terms of volume, so it needs to an assessment and not an assessment, a stabilization of the consumption that will come normalization after this huge price increase. We are continuing to improve the set of tools to improve visibility and rotation, but it's really a game country by country. It's very difficult to encapsulate that in only one figures. Overall, at this stage, EMEA is the region in which we need to focus more for liqueurs and spirits to be able to deliver a clear and steady run rate, positive run rate for the future, because of the different situation of every single market. It's a global, very complex situation. For the US, it is a complex and very easy to answer situation. There is a clear misalignment between sell-in and depletions. What I tried to say in an elegant way before is that sell-in is negative, clearly running behind the performance on sell-out and depletion. And we can say that sometimes on a given quarter, Nielsen is negative, but we look at all channel. Nielsen, remember that for us, is totally not representative, only 35% against 44% for the market, because not taking into account some major chains and independent local stores, in which we are beating other peers. So this misalignment is linked to what in the US, and we need to solve. It is not a strategic point, it's more a tactical negotiation execution point. But that we need also our wholesalers in the US to play the same game. The stocking following Q4 negative depletion, clearly, but strong cautious from them, for wholesaler, and they are to record in global context. Value depletion are positive. So in a nutshell, cognac depletion underperforming for Rémy. Rémy is cognac, is weighing negatively for all other brands. And it's our job, but the job also the wholesaler, to understand that we in 2024 we need to work in a more analytical, skilled, and digging basis. So overall, at group level, I repeat, we think that there are more conjunctural specific elements that are weighing with the negative news of the publication. I'm really aware that Terracotta Spirits is a miss compared to the expectations, but it is more conjunctural than long-term threats. And every single region and country for EMEA need to have a specific boost plan or re-engineering plan to address that, starting with Cointreau, but not only Cointreau, also for Bruichladdich and for Europe, Metaxa as well. Metaxa specifically was penalized also for some changes in route to market in Eastern Europe, as I said. Please.
Sorry, Luca, just to clarify if I understood what you just said on the US destocking situation. You're saying that the situation in cognac with very weak depletions and the destocking, that is also weighing, or that is driving in part the destocking that you're seeing on your other brands. So it's an execution thing that you have to fix in how you're dealing with the distributors.
Totally exact.
Thank you.
Cognac underperformance is overshadowing positive news, so it is an execution element to fix, in which we need also wholesaler collaboration. We can't react only to looking at global figures. Brand by brand, SKUs by SKUs.
Perfect, thanks.
We will take our next question from Edward Mundy. Apologize. We will take our next question from Sanjeet Aula, UBS. Your line is open. Please go ahead.
Hi, Luca. A couple of questions from me, please. Firstly, can you just elaborate on the implementation of the VSOP Boost plan, how that's progressing? Appreciate it's early days, but any color you're able to share as you've made those changes in the US over the last couple of months. And my follow-up question is on EMEA. You called out intensified promo activity. Can you just go into a little bit more detail? Is that broad-based across categories or any particular categories and markets you'd call out where you've seen that step change? Thank you.
Thank you so much for your question. Let me allow to give to yourself, everybody, a more global vision of what's happening, the current trading in the US, apart from figures. So it is clearly there that Q1 depletion in the US showed a sequential deterioration versus Q4. So first top for tagline, there's a deterioration. Why that? High comps last year before the implementation of price increase to retailer, June was up mid-teens for the cognac category. The exit rate was very, very strong. Tough market, still driven by strong promotion. And we are far less promotional than other peers, as you know, and promotion intensity is not lowering, absolutely not. You can also see it in our spreadsheet when we bench on 3 months or 6 months the market, and number discussed compared to our peers. You will see a huge positive. It's clearly driven by other ranges that we do not have in the portfolio, i.e. VS. That means also, what does it mean in terms of alignment between sell-in and depletion for other big peers? Spirit market slowed overall versus Q4. So market is low in that. Current trading, we do not see the spark yet in the US. Limited visibility, still negative. Let's see how the next quarter will move forward. So far, small positive news. July showing a strong sequential improvement. I'm not saying positive, but strong sequential improvement. Too early to determine if it will be sustainable and lasting for the Q2, even if on the low base. Another point is important to highlight is the asymmetry between states. We are clearly some very good performance in the US, Georgia, Nevada, and we have huge underperformance, California, Texas, New York, and partially Illinois. So it is a very complex dynamic state by state. It's like having a huge European state inside a lonely US market. We are just penalized on the positive side implementation of our boost plan. We started to reinforce our activation point of sales from the SOP. We implement our smart pricing strategy that Iqbal highlighted very clearly with thresholds. The duties can be up in some states, down in some states. We have a threshold which is aligned. Too early to conclude because just started. The benefit should be there more in the Q2. So far, we recorded encouraging trends in a few states, one of them Michigan. Then, if all confidence and the market is still down, it's very difficult to acknowledge the performance. It is more a performance which is less negative should have been than the clear positive. But so far, some encouraging trends in some states, I repeat, and end of Q2, we will be more precise on the result of the boost plan on BSOP. We have signed also something very important, new partnership with Usher that will also contribute to animate the coming months. And we are confident that we can be better than today. But so far, for the short term, Q1 was a deterioration, and Q1, in terms of depletion, was clearly in miss compared to our expectation. So global, overall, at group level, not only US, we have a very marginal miss in sell-in, and more important, some points more in terms of depletion compared to our internal estimation. Lagos and Spirits, let me repeat what I just said, but it's very important. For the US, we have a misalignment between sell-in and depletion, for the reason just highlighted, the stocking following Q4 negative depletion, and a strong caution from wholesale to take orders in this current context. Value depletion are very positive, including for Cointreau at The Botanist, top of mind. Fundamentals, specifically on Cointreau, are very, very solid. We gained market share very clearly in 2023, 0.9 points and 7 points of market share compared to 5 years ago. And we intend to continue to leverage this good momentum. In terms of EMEA environment, I will try not to be too long because it's a complex region. The current trading, apart from figures that you already highlighted, Q1 sales were impacted by softer underlying trends. Inflation waves on purchasing power, the fact that we increased strongly our pricing last year, and we took time to consume it to absorb it. High comps in the UK, some negative phasing effect, particularly Eastern Europe, waving on Metaxa, and weak markets in South Africa and Nigeria. In terms of dynamics and depletion, down mid-teens and down low single-digit on 5-year basis, and inventory back to healthy level. The global environment, I repeat, is more complex than other states because it's state by state, country by country, operational plans that need to be put in place. And with the new organization that has been changed beginning of the year, as we highlighted the full year result, we switched from a more geographical footprint and business unit system to a more developed market and future growth. So there is also a time of this new organization to be put in place. The the question you might have is, this is slowdown more an ongoing concern, or this is a short-term issue? So far, at this stage, we continue to think that Europe will be able to deliver a positive top-line dynamic for the year. But we started lower than the expectation. So we don't think there is a long-term issue. It's a short-term problem linked to inflation, reaction to consumer, normalization, and adjustment or route to market in our organization to this new environment. So we should witness in the coming quarters, and more clearly from the Q3, a recover and respeed of the region. I hope it was clear.
Great, thank you.
We will take our next question from Edward Mundy. Jeffries, your line is open. Please go ahead.
Hi, Luca. Morning. Two questions for me first. So on China, it appears that your performance is a little bit better than your peer who reported yesterday. Clearly you've got a slightly different portfolio with that gap between VSOP and XO closed with Club. But can you talk about some of the other differences perhaps between your business and your peers' business, in particular on route to market with your very strong e-commerce and also potentially your channel exposure, relative to your peer? What is it that allows you to potentially outperform your peer within China is the question. And then the second question is around your guidance. We're clearly one quarter in. I think you're signaling there's no new news really. Today you'd had expected the first quarter to be quite tough. But do you think the second quarter will be just as tough as the first quarter, or do you think it'd be worse, or do you think it'd be better? I appreciate that Q2's also got very tough comps, relative to pre-pandemic levels.
Thank you for this very easy question, finger in the nose. China. As we said, if you look at our figures on depletion for Q1, first reaction is that there is a stocking impact at the end of the Q1. Today we try to animate this conference and Q&A even more, taking also part of your question, thinking, and not be trying to tackle the point in a very clear way. As I said, on a 6 months basis, this is totally reversed. And part of the footprint and the business model compared to 5 years ago changed the way we operate. We are more China home and less reliant on travel retail, on operators in Macau and Hong Kong. So you cannot compare apple to apple in a very clear way. But overall, we are running at value depletion on a moving average in a very positive way, in our opinion. However, to moderate that, the mid-teens decline in depletion encapsulate an overall slowdown of the activity on top of high comps. So to be able to confirm the fact that we are clearly able to beat our peers in China, to tackle your question, we need to assess the situation very clearly at the end of Mid-Autumn Festival, Chinese New Year, Q2 and Q3. This is key. The quarter is 15% Q1. The very important part, more than 50-60%, is Mid-Autumn Festival and Chinese New Year. And so far, on the negative side, I will start on purpose on negative, not because I'm bearish today, but because I want to be clear, and then I will detail the positive side. Low level of confidence in the country, real estate, poor performance in finance sector, high unemployment, low expectation economic growth, and consumers showing their willingness to be lucky by spending less on high-end products. You can see also in our performance, I said very clearly, Club is beating and the high-end is a bit underperforming. Cash pressure in the trade, they are clearly visible. So we deal with that, but we do not compromise also to sell in with the trade terms of MED. And, if I may say that, a bit of nationalism sentiment protectionist consume local. On the positive side, so why we are getting there, why we think we are going to be proud of our performance in China at this stage. because for the negative channel overall, new on-trade, we are less exposed, so we have also this kind of chance. Off-trade, we are continue to doing a very strong job. Our team, we are very proud, is very strong. We have a very strong China team. E-commerce is a deadly weapon, positive speaking. Every time we get in touch with consumer, I said it every time, but the results are there. Every 18 of June, 11/11, we are clearly beating our internal estimation and beating competition. And overall, even if it's complex, our switch on direct sales for some part of our business, our retail part for Louis XIII, it is improving in terms of image, and it will be soon in terms of result as well. So we have some advantage in terms of channel, in terms of teams, in our opinion, in terms of lower exposure to the on-trade. So for the year, we do not change our forecast for China. It is more complex in terms of global environment than estimate, but so far it is to be slightly up, both in sell-in and depletion for the year. I repeat, at this stage, but everything is linked to two important moments. Everything can be better or worse. MAF, Mid-Autumn Festival, and Chinese New Year, combined between 55 to 60% of the business. On this point, MOFCOM custom duties can waive only in terms of financial, not in terms of consumer sentiment. So far, we didn't get any negative impact about the investigation. So I try to answer to you in a balanced way, putting in the first line the negative elements in China, for us and for everybody, and what it makes the difference. Guidance. Too early to comment precisely. It's only the start of the year. What we confirm is that the year is very unbalanced between H1 and H2. Timing US recovery comps, depletion are running worse than the Q1 of the sell-in is something that is a red point, so we cannot ignore that. It is enough to change the guidance? No. We believe in the guidance. It is something that can waive on Q2? Yes. At this stage, the visibility is blurred, but we are committed. There are three important positive points in this publication, and I'm quite modest, and I don't want to put China better than peers on that. The first one is Japan, something common. For fundamentals, also yen. The second point, which is specifically for us, in this point I will not be modest, e-commerce. The third point, very positive. The fighting spirit is there. Everybody is committed. It's not because we are minus 15.6 that we are sitting in our offices looking at the figures, making simulation, and resetting the 6 revised forecasts every day. We are fighting. Then we will count, but we are fighting. That's why I also made some comment of collaboration. All the chain of actors need to be mobilized with the same fighting spirit. So, what's the consequence for your estimation? That based on the strong negative Q1 performance there, and depletion being a little bit worse than our expectation, and worse than sell-in, 15.6, 18.6 on depletion group level, visible alpha consensus today seems not to take into proper assumption the asymmetric trends between H1 and H2. So far, the consensus on top line H1, visible alpha, if I'm not mistaken, is more or less minus 9.5, minus 10. So it is too optimistic. So gives space to the second part of your question, short term, what we'll be having tomorrow for lunch or for dinner. What is expected performance for Q2? No spark visible in Q1 in the US for depletion. End of Q1 group level shows a slight stock overall compared to end of March. Why? I repeat, Sell-in -15.6%, depletion down 18.6%. Based on current trends, so I'm really not sure that will generate a sequential improvement in Q2 versus Q1 in sell-in. July started better in depletion in the US, but too early to conclude, I repeat, if this trend is sustainable, and it will be enough to encourage wholesalers to increase orders and stock that are at the minimum level. So I'm sure that Trevor Stirling is thinking, what you will do, his question will be, when tomorrow depletion back to positive and will call you at the phone every 2 minutes to replenish, will be out of stock in 2 days. Because he's right. Trevor is right. It's what will happen. China is still impacted by high comps, plus 100% in Q2 last year versus Q2 1920, even if it was another way of operating. And the market remains very tough, particularly for high-end segment. And EMEA, too early to determine if trends will improve during the summer. We are mobilized on that, but it's still tough. So, all in all, I think you understand, for the Q2, we will not be in a positive land, and also the sequential improvement compared to -15.6, I'm not sure that will be there. I cannot be more clear than that. We are committed on the guidance. But is very, very different from what you are expecting right now in Visible Alpha.
Q2 is going to be the same as Q1 or worse.
We will take our final question from Lawrence White. Barclays, your line is open. Please go ahead.
Morning, Luca. Thanks very much for the questions. A couple from me as well, more clarifications. But you had a very strong performance in Japan, and I was just wondering what's the relative...
We miss you. We are not hearing now. Something happened.
Apologize. The participant line seems like disconnected. So once again, Lawrence White, if you can hear us, please press *1 to join back into the queue. We have Lawrence White back on the line. Please proceed with your questions.
Hi, Luca. Don't know what happened there. I could still hear you all the way through, but just to repeat everything.
I'm sure that you are not blackmailed by me, not because you are saying that I blackmail you. I know. Well, you are one of the more positive. You will be back one day, I'm sure.
Exactly. Just a couple of questions then. On Japan, just wondering what the relative pricing environment is in that country, particularly versus China. Do you typically are you currently selling products in Japan at about the same price as you're selling them in China, and are people buying higher end or lower end products in Japan versus China? And then secondly, just given the relative weakness in the on-trade recently and your current high strength in e-commerce, could you give us a breakdown of sort of the sales splits between those three regions, your on-trade, your off-trade, and your e-commerce, just to help us understand that? Thank you.
Thank you for your question. So, Japan for us, we are not LVMH. Japan is a positive element, but it's very it's small weight, so it's 2%. So clearly there is some sales that are going to the Chinese tourism. Maybe what you are intending here, that can be some traders making some deals to replenish the China market. It is marginal, and clearly the weak yen is playing a role, but at group level, at group scale, can switch the weight of 1% to 1.5 to 2.5. So we are talking about 5 to 10 million. So at global level, so it is not a disturbing factor affecting the local basis of consumption. What is affecting is part of travel retail performance, because maybe you have some local sales in Japan for the Chinese tourists that are in Japan that should belong to the other type of But at the end, the disturbing effect on top line, very minimum, increasing at the lower gross margin, marginal group level, very marginal. Bottom line, not much assist on EMP, so bottom line, it is squared. In terms of weight, today, the weight, it is, for us, in on-trade, is no more than 5%. Used to be 40 to 35 before COVID. We are very weak today in on-trade, which is a negative element. We can improve. It is also protection in the short term, also because on-trade in China is less profitable than it is profitable, but it is less profitable than off-trade. E-commerce so far it is 35% of the weight, so the difference is the all remaining channels, so between off-trade, the direct, and the weight of the e-commerce. Don't forget, will be normalized in Mid-Autumn Festival in Chinese New Year, because in that part, classical business, wholesale and direct sale will improve. So yearly level should be between 24 to 27% in terms of weight of e-commerce. Frankly speaking, we prefer to be 20% as well, because it means that the other channel is improving compared to the actual scale of growth. At group level, this is an important point. E-commerce now, end of Q1, group level, not China, is 18% of the business against 43.6%. So the group total realized minus 15.6%. E-commerce channel, all countries, all brands together are slightly negative, more or less flat, with China booming. So every single country is doing more than its job on this channel. And thanks God, we think that this is a clear, distinguished, positive weapon that we have. Thank you.
Thank you very much.
See you in September.
That is all the time we have for question and answer session today. So I will now hand you back to your host for closing remarks.
I don't have any special closing remarks. So I hope that you will have a very nice, peaceful summer. Have fun, and see you and during next month, and talk to everybody end of October for the Q2 and H1 top line performance. Have a safe and beautiful summer. Ciao, ciao.
Thank you for joining today's call. You may now disconnect.